Like I said, what we are going to be focused on today is the market. When you open a chart like this, what do you see? What are you supposed to look for? How do you interpret what is before you? That is what we are going to be focused on today. So if you look at my chart, I have um, I have the chart I am currently on is the chart of USD CAD. That simply means that United States dollar against the Canadian dollar. So what does that mean? Now, from the past explanation I've made, when you look into the market and when you are trading um, currency pairs, which is the popular thing we do in forex trading, of course, I've established the fact that we do other trading, like commodity trading, like metal trading, which could belong to, like sugar trading, crypto trading, and every other trading. But then, if you're trading currency, which USD CAD is one, what does it mean? So if, for example, let me quickly use a notation. If this chart decides to go up, what does it mean? It simply means that USD is strong. That is, the US dollar is strong in the market against the Canadian dollar. And that's why the chart went up. Let me show an example of what I just said. Now, look at this point here. Look at how this went up. Look at how it went up. It's what happened here actually is for this length of time, the US dollar was strong against the Canadian dollar. That could be the reason. One. The second reason could also be that the Canadian dollar was weak against the US dollar. That could also bring USD CAD up. And then the third scenario is both can happen at the same time, meaning that USD can be strong, Canadian dollar can be weak, and then you will still have the same result. So what happens when we have US dollar strong in the market and Canadian dollar also strong in the market? Most of the time we have zigzag movements, price not going up, price not coming down. We have all of that. Look at the kind of movement you have here. So it means they are both um, demonstrating same type of weakness or same type of strength. That understood. Now that's also how every other pairs work. Either it is Euro USD, Euro JPY. By the way, Euro JPY means Euro against Japanese yen. GBP JPY means the British pounds against Japanese yen. USD JPY means US dollar against Japanese yen. XAU USD means gold. XAU is gold. So XAU USD means gold against the dollar. So that said, that's fundamental and we need to understand that. So that said, when you open a chart like this, what do you see? Now, you might see that, okay, you might say that what I see is just a collection of red and blue sticks going zigzag on the market. Yes, you are right, but much more than that, there are a lot of things I can show you on this chart. So tonight we are going to be looking at something. Every time you look at a pair, I mean a chart like this, any chart at all, anything at all. So if maybe after this class you can, if you have any newspaper around, scroll to that point where they used to draw charts for Market Watch and look at a chart there, because when I started getting interested in the financial market, that was where I started from. I didn't understand what was written there or what was drawn there, but I just knew I loved looking at these charts, even though I didn't understand what they wrote there. So when you look at a chart, what are you looking at? So basically, this is what you're looking at. Every time you look at a chart, and then let me also say that, you know, this chart ends here, but then it did not start here. So we can keep dragging and keep dragging until God knows when we are going to get to the end. So you cannot have all the chart history on your screen size. Of course, if you go to a higher time frame, you probably have, be close to that. But the truth is, no matter what you do, you can't have all of those all of the chart history on your screen side. So focus on what you can see. And let me say this also, what you see here is as good as a storyteller. So more like a story coded in sign language. You know, if you don't understand sign language, you cannot understand when to verbally impaired people are speaking to each other. So the same way this is, it's coded in sign language, coded in a language that you have to learn to be able to read it. So, and then what we are going to be doing going forward is for us to be able to read that coded language. So for example, what you are looking at is a chart. And when you look at a chart like this, you can only have one or three things. You can only see one of three things. So what are those things? The first thing is this. You can see what we call an uptrend, uptrend. You can see a downtrend. Or you can see a ranging market or consolidation. You can see an uptrend, a downtrend, or a ranging market. You can only see one of these three. Nothing more, nothing less. It can only be one of these three. So the question is, the one we are currently looking at, what is it? The one we are currently looking at, based on what we have on our screen, from here to here is an uptrend. From here back to here is a downtrend. Because market went up, uptrend. Market came down, downtrend. Now, if you understand that simple term, you are getting to gain the knowledge. But then the question is, why is market not just going up like this, just go up, down like this? Why does it have to do a zigzag kind of movement? So why does it have to move like this, for example? Why does market have to move like this? I don't know if you've noticed. Why does market have to move like this? Why not just like this straight down? It's because that's, and this is where the name trend comes from, because it is trending up, not moving up. We could have called it up move or move up or whatever it is, but we said up trend, that is, it is trending up, goes up a little bit, retrace a little bit more, goes up a little bit, retrace a little bit, goes up a little bit, retrace a little bit, and not just move up like this. Same thing with downtrend. Why not just come down like that? Why does it have to move like this? Goes up, it goes down, come back a little up, goes up, then all of those kind of movements that we've seen in the market. Now, it's the reason for that trending thing is because every time you look at the market, there's a war going on, and it is a war between two type of people. We call them the bulls and the bear. And that's why anytime you see a magazine or an article written concerning a topic that has to do with the financial market, they always use picture of a bull fighting a bear. Now, it is not just a fine picture to use. It's because that is what the financial market is all about. So, what is a bull? Or who are bulls, who are bears? Bulls are people that believe markets should move up, or this thing is too cheap, it should become, the price should go higher. And then bears are people that believe it is too expensive, it should come down. So in the real sense, bulls want to push market up, bears want to push market down. Let me make it clearer. Bulls want to take the price of the commodity or the currency you are trading. Bulls want to take it up, bears want to bring it down. So what you have in the market, daily, monthly, whatever time frame you are looking at, is a war between bulls and bear, so that you can be able to remember that name clearly and understand and not miss bull for bear. Let me help you understand where the name came from. Now, the name came from the style of fighting of those two animals. Now, the bull fights by lifting his enemy upward. So if a bull is going to fight, he's going to put his arm under and lift the enemy up. And that's why we give people that believe market should go up that name, bulls, because they want to take price up. And then the reverse is the case for bear. Bear wants to bring its enemy down. They want to bring the enemy down, and that's where the name for bears came from. They want to bring price down. So every time you look at the market, there is always a war between the bulls and the bear. The people that are bullish and the people that are bearish about a particular market, particular commodity price, currency pair, or whatever it is you are trading. So, for example, now bears push the price. Okay, let me use another annotation button. Bears pull the price down like this. Bulls pull it up a little bit more. Bears pull it down again. Bulls pull it up a little bit more. Bears pull it out again. Bulls pull it, and then that's how we have this kind of structure in the market. That's how we have a zigzag movement in the market. And same thing with an uptrend, because the bulls push the price up, bears brought it down, bulls push it up again, bears brought it down, and then bulls again, bears again, bulls again, bears again, and that's what we have. So that's how we got a zigzag form of movement in the market. Now, is that clear before I continue?
Very clear.
Okay. Second, who spoke just now? Hello?
Sure. Faith.
Okay. Stephen, is it clear? Hello, Stephen. Hello?
Yeah, it's clear.
Okay. So, so that said, let's continue. So when you look at markets, you want to be able to tell at just a quick glance, is it a bullish market, a bearish market, is it an uptrend, a downtrend, or a consolidation or a ranging market? Now, that's first thing in the market. So I have 5 charts here, and then we are going to take it 2-2. So I'm going to open a new chart, and then one of you is going to tell me if it is bullish, if it is uptrend or downtrend. And then I open another one, the other person say if it is uptrend or downtrend, and I open another one. So we are going to look at 4 like that. So this is Euro USD. Sheung, is it uptrend or downtrend based on what we have on our charts? I'm waiting for your response. Hello?
I think it's majorly an uptrend though. From Steven.
Okay. Sheung, can you hear me? Are you there? Hello, Sheung.
Yes, I can hear you. Yes, I can hear you.
Okay. So Stephen already answered that. So the next question is for you. Did you get that?
Okay, I'm with you.
Did you get the question I'm asking actually?
I get the question you're asking. I get it.
Okay, so let's go to the next chart. By the way, Stephen, you are correct. It's an uptrend. Price moved up. Correct. So this one is for Sheung, and I'm going to. Okay, so Sheung, this chart, is it bullish? Is it uptrend or downtrend?
This also uptrend.
Okay, this is also uptrend. True, because price went up. Stephen, the next is for you. GJ. So Stephen, is this an uptrend or a downtrend? Stephen.
I think it's a downtrend actually.
Stephen, is it uptrend or downtrend?
I think it's a downtrend.
Why?
The prices kind of weren't going too Or like they weren't going too high, I think.
Well, it's still an uptrend, I feel.
But towards the end, it was moving up. Yeah.
Now, the truth is, when considering uptrend or downtrend, what you need is markets higher than where it's been before. That's all you need. It doesn't have to go far, far, far into the sky. Anything that takes price higher than where it's been before is an uptrend. Do you understand that?
So are you saying the last point is actually maybe probably we're relating between the last point and probably not far away
Now,
from it?
look at this. Look at this movement.
Yes,
First
it's an
leg,
uptrend.
then like this, then like this, then like this, then like this. You can see,
Yes.
so it's an uptrend.
Okay.
So if price has gone below somewhere here, maybe price fell again like this, like this, like this, like this, like this, like this, and then that's when we have a downtrend because price has moved
Oh,
down.
okay. 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 Very well. Understood.
Okay. So Sean, the next one is for you. Um, UJ. Okay. Okay. So what is this? Sean, what is this? An uptrend or a downtrend?
It's a downtrend.
Why?
Obviously, from where it's starting from, even from where the screen, the extent the screen is showing us, it shows that the price will still go down from what we see. And from look at where you write consolidation and down to that point. So it's a downtrend. The price is
Okay.
going down.
Okay. So you are you are correct, and then that's going to push me to the next thing I'm going to. So this is it. It's a downtrend. Hello, can you hear me? So it's a
Yes, I
downtrend,
can.
but then this trend is getting challenged a little bit. But I'm going to get into the concept of a trend getting challenged, a trend getting tired, and all of that shortly. Maybe not in this class, but I will surely treat that. So the next thing I want to talk about now, let's go back to our USD is the fact that if you, I am currently on D1 time frame. What is D1? D1 simply means daily time frame. And what does that mean? What does that English actually mean? It simply means that every candle that you see here, and what is a candle? Each of these structure is a candle. You know, they have different shapes and sizes, but each of them is a candle. So each of them took 24 hours, a whole day to form. So that's what it means to be on daily candle. So I could go on monthly candle, meaning that each of the candle is a whole month. And I could go on 1 minute time frame, which means that each of those candles is 1 minute. So what does that mean? But then before I get ahead of myself, anytime you want to trade as a day trader that you and I that we are, don't go above D1 and don't go below H4. So always stay between D1 and H4 when doing your analysis. It's best for the kind of trading we do. So I was going to say this. It is easy to say, okay, this is a downtrend, this is an uptrend. But then what happens if, because it is possible that you go on a higher time frame, for example, monthly time frame. Okay, let me use this as an example. Look at this. This is H4. This is 4 hours time frame. It is a downtrend. If we go to monthly time frame, it's an uptrend. That might be confusing. I mean, one time frame is saying downtrend, another time frame is saying uptrend. So which one should I believe? Now, this is it. I just want you to know that there's a possibility of you having, different trend. There's always a trend in a trend. I'm trying to make this as simple as possible. There's always a trend in another trend. So if we go to, for example, M15, This is 15 minutes. So this is a downtrend. But then if we go to H1, it is probably just few candles on each one. So I'm just saying that to say that your trend is only valid, or it's only, I mean, don't be too rigid when you have a trend on a particular chart. Be open to what other time frames are saying. So if I check H4 and I see uptrend, I'm downtrend. If I go to D1 and it's still downtrend, I'm cool. But if I go to D1 and I see uptrend, it simply means that market is actually going up. But because markets normally do a zigzag movement, up, down, up, down, up, down, and that is why I saw a downtrend on H4. So market is in an uptrend, but then there's always a retracement. So what I saw is probably something that fell around here. I don't know if you get my point. If you understand this, you have understood some basic concept in trading. So in D1, I saw an uptrend, but on H4, I saw a downtrend. What does that mean? It means that what I'm seeing is a retracement of the uptrend. So let me explain this in the right term. I'm trying not to use the term before, but now that you understand, let me use it. Let me use the right term. Now, for any market you open, there are two types of move. We have the impulsive move and the corrective move. Impulsive, corrective, impulsive, corrective, impulsive, corrective, and that's why it goes. For an uptrend, the one that goes up is the impulsive, the one that comes back is the corrective. Impulsive, corrective, impulsive, corrective, impulsive. And then if you go to a downtrend, it is reverse is the case here. Why? Because we have the impulsive, corrective, impulsive, corrective, impulsive, corrective, impulsive. That's how the downtrend works.
Hello,
So, hello, can you hear me?
hello.
Hello?
Sorry, I got lost in the last 3 minutes. A call
Okay,
entered for me.
okay. 3 minutes, 3 minutes. So,
Just 3 minutes ago.
what was the last thing you had?
I heard you're talking about a trend in a trend.
Okay, so
This is trend, like in based on H4, D1,
okay, okay.
all those stuff.
So, in essence, I'm trying to say that the higher time frame you go, the stronger what you get out of the market. So if H4, if H1 says that, if D1 rather, D1 says that market is going up. If D1 says market is going up, it's an uptrend. And then you go to H4 and you see a downtrend. What is most likely happening is, out of that, what you are actually seeing on H4 is something that falls around there in the D1. Let me draw this thing again. So H1 says market is going up. I mean, D1 rather says market is going up. But by the time you got to H4, H4 is saying that market is going down. That is a downtrend. So I'm not saying that it is not contradictory each other. What you're actually seeing on H4, because H4 is a smaller time frame to D1, what you're actually seeing on H4 is something that falls around here in the market. That is the retracement of the uptrend. So, and that actually led me to using the right term to explain this. So I said that every market you open, there are actually two moves, the impulsive and the corrective. Impulsive, corrective, impulsive, corrective. So the impulsive move in the direction of the trend, the corrective move against the direction of the trend. So, and this also happened in a downtrend. Why? Because there's always an impulsive, corrective, impulsive, corrective, impulsive, corrective, impulsive. The same way. So this is the impulsive move of a downtrend, the corrective move of a downtrend, impulsive move of a downtrend, the corrective move of a downtrend, and it goes that way, that way, that way. So, and that's what it means that there is a trend in a trend. Why? Because if you look at this, for example, this also did not just go up like this, it also went up like this. The same way this also came down like this. So if you are to zoom out your chart into H4 and you saw something like this, something that falls into something like this, you could say market is in an uptrend. Am I right?
Yeah, market's an uptrend.
So
Yeah.
you could say market is in an uptrend, but then by the time you go to a higher time frame, you find out that this uptrend I'm looking at is actually a corrective move of a major downtrend. Is that clear?
Sure.
Oh, then,
Clear, clear.
then my work is done today. If you understand this concept, then you understand something very basic that many people don't understand about trading. So that means that you can never be confused about seeing different trends on multiple time frame. And that is, I'm glad I'm able to pass that message across tonight. So it means that you now understand that if you go on H1 and you see a downtrend, you can go to M15 and see an uptrend. You understand why, right?
Yes, yes.
Okay,
Yes, yes.
okay. Then that is cool. So now that we understand that we could see a downtrend, an uptrend, or a consolidation. We've spoken about downtrend, we've spoken about uptrend, but we haven't mentioned consolidation. So what's the consolidation? Consolidation are in different, they can occur different ways. But then let me tell you why they occur in the first place. Consolidation is a resting moment in the market where market is resting before it moves again. You know, we said we have corrective move, we have impulsive move. Now, most of the time, before there's a major impulsive move, there's always a consolidation because, for example, if you are to run between Lagos and Ibadan, you cannot keep running. There will be a time your speed will reduce, or you will literally wait and catch your breath and probably relax a little bit before you start running again. The same way the market works. So the market goes zoom, 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 and then it rests. That's consolidation. How do you know a consolidation? You will see that the candles around consolidations are always smaller. That's one type of consolidation. Candles are always smaller. They're always moving between the same range of price. What am I saying? Let me show you an example of what I'm talking about. So let's use this. For example, look at this. This is, look at this. And then many of the time they are candles that are, um, so look at this. Look at this. If we zoom in again, we'll see more. Look at all of this. We zoom in, we'll see more. So they can occur in a small place or they can occur even in a large place. So what am I saying that they can occur in a large place? Now this is one. Market keep moving, zig, 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 until it breaks down into an impulsive, until there was an impulsive move. So when market is in a consolidation, we don't trade. We take that time to study where market is going to go next. And that's what we focus our attention on. Trading a consolidation is the easiest way to lose money because consolidation will always move up and down, up and down. It's directionless. And then the range is always, so the range can be big, the range can be small. This particular range is just 23 pips. If you go to a higher time frame, we'll see a bigger range. So but then the idea is don't trade a consolidation, wait for it to break out, and that's where the name breakout means. Let price break out of that consolidation into a trending market. A trending market is what you want to trade. It doesn't matter if it's uptrend or downtrend, but a trending market is what you want to trade, not a consolidating or a ranging market. Avoid a ranging market by all means. It is the easiest way to lose money. Of course, there are ways to trade consolidation and breakout, but we'll get into all of that. But then, like I said, you don't want to trade a ranging market. You don't want to trade a consolidating market. You only want to trade what? A a trending market, regardless either it is uptrend or downtrend, you really don't care about that. What you care about is it trending? Yes. So, and how do you know if it is trending? Because there's corrective and impulsive move. So there's corrective, there's impulsive corrective, and that's what you want to know, and that's what you want to trade. So before I call it a day in today's class, let me quickly chip this in. So how do you trade a changing market based on knowing what we are talking about now? How do you trade a ranging market? Let me use an uptrend for example. So if market is going to trend up, it's going to go this way: impulsive, corrective, impulsive, corrective, impulsive, and all of that. Now, let's say we woke up and we saw market here: impulsive, corrective, corrective. Now, the truth is that market moves up, comes down again, moves up again, comes down again. So the best place to actually take a trade for a confirmed uptrend is to wait for it to come down and then buy. If you buy from here, you are going to enter profit straight. And then you take your profit here before market comes down again. And if you want to, you buy again, then market takes you up again. You take your profit, and then before market comes, and that is literally how we trade trend. It is that simple. But then I must also let you know that there's what we call key level, support, resistance, all of that. I will take that in the next class. Those are, they look imaginary, but they are the reason price is going back and forth. Price is always going back and forth around them. So the first thing you want to do is to at least draw those levels. And that's why anytime you open my chart, you will always see that there are lines, and you can see all of those lines, all of those. Can you see all of those lines I drew here? Hello?
Are you referring to the blue lines?
The blue lines, the red lines as well, the black line as well.
Okay, I can see them.
So now those ones are key level, but I don't want to jump ahead of myself. So just know that when we are dealing with an uptrend, we don't take an impulsive move. We don't buy on an impulsive move. We wait for a corrective move. Does that sink? Do you understand that?
That's when it's coming down, actually.
Exactly. So this is let me use another. So this is an impulsive move. We don't trade an impulsive. We don't trade when it's already going up. We wait for when it's coming down, waiting for it when it's correcting, and then we buy from here. It makes a lot of sense to buy a corrective move than to buy a impulsive move. Why? Because if you buy, let's say you bought an impulsive move, let's say you bought it around here, you never can tell when market is going to come down, because you are buying something that is already almost getting tired. Do you understand? But the goal here is to understand where market is likely going next, so that you can know where you are going to enter and when you are going to exit. And that's what we are going to be building on in the next class. So now you know how, and then let me use an example for the downtrend as well. Impulsive, corrective, impulsive, corrective. So we wait for a corrective move, then we sell, then bam, in profit. So if we have sold here, let's say we sold here, we might eventually become, be in profit. Let's say we sold here. The reason why we sell here and not here is because if we sell here, our account will first go in what? Minus, red, because market is going against what we predict it will go. We predicted that the market is going to go down, but market did not go down immediately. It went up first. So market went up, and you never can tell when it's going to stop. So if before it stop, your account has emptied, your account will not empty, and the market will not go your way. And that's why people say, yeah, and that thing took me out and then eventually went my way. It's a very common statement with traders that I lost, I didn't make money from the trade, but it still went my way. Now, it's not only, it's important to know where market is going, one, it's much more important to know when to enter. Do you understand?
Somehow.
Shield, do you understand?
Yes, I get you.
Okay, so before I start asking question, before I give room for question, this is I'm going to give an assignment, and the assignment is this: open 5 charts, different charts entirely, and then screenshots. So we're going to have 5 uptrend, 5 downtrend. So give me 5 uptrend, 5 downtrend, and you're going to send it to my mail or send it on WhatsApp so that we can discuss it back and forth. So between now and the next class, we're going to do that. This Zoom call is going to end in the next 2 minutes. If it does, just click on the link again because we are not done. We still have to discuss question and answer. So that question, I don't want to, that assignment, I don't want to forget it, and that's why I'm saying that. So now that I'm done with what I have to say today, any question?
So basically, what we discussed today was just on the charts,
Yes.
understanding the charts better.
Yes. So what we did today is basically market structure, understanding the market structure, and it's just a part of it. We'll continue from there, but um, I don't want to do something that we will not be able to understand anything. That's why I'm making it, I'm cutting it bit by bit so that we can chew it well before we go to the next thing. So when you look at the chart, what do you see? An uptrend, a downtrend, or a consolidation? If it's an uptrend, if it's an uptrend, can I see the impulsive move? Can I see the corrective move? Can I see, if it's a downtrend, can I see the same thing? So for example, look at this downtrend, for example. This is an impulsive, corrective, impulsive, corrective, impulsive, corrective, impulsive, corrective, impulsive, corrective, impulsive, and a corrective again. So you can see that everything I do on the annotation, user annotation, they are actually real. So impulsive, corrective, and that's how we have the market goes up and down. So, and if it's an uptrend, also, we have, we can have that also play out. So, Shane, do you have any question?
No, not. I'm still thinking about my question, but I know when I think about the whole stuff, I might have a question to talk to discuss with you later on.
Okay, but
I'm
what
still
I'm gonna do
digesting it.
is